McKinsey's top insurance. As 2023 begins to take shape, we review our most impactful insurance articles of the past year. January 3rd, 2023. Several topics dominated insurance leaders' agendas in 2022. Enduring profitability challenges, the unyielding pace of maintaining a competitive edge, and the mounting impact of inflation. All year, McKinsey's publications covered the spectrum of subjects to help provide context and guidance as leaders tackle today's most complex business challenges. We've highlighted our most noteworthy insights below. Life insurance. Global Insurance Report 2023, Reimagining Life Insurance, following the inaugural 2022 Global Insurance Report, released in February 2022. The first chapter of the 2023 report delves into the major forces at play in the life insurance industry and the business model decisions insurers will face as they seek to accelerate growth and exceed performance targets. Ultimately, a changing industry landscape can allow insurers to overcome current performance challenges by transforming where and how they generate value. An accompanying podcast features 4 McKinsey insurance practice leaders discussing industry trends and how companies can be successful by rethinking the life insurance model. Listen to the podcast or read the transcript. Unbundling value. How leading insurers identify competitive advantage. For U.S. life insurers to address new and old challenges, they need a fresh approach to their business model and how they create value. Grow or exit. Overcoming the scale trap in life insurance closed books, the COVID-19 pandemic has exacerbated challenges for insurers in continental Europe. Manda deals with closed book players can help insurers continue to create value. P&C insurance. Countering inflation, how U.S. P&C insurers can build resilience as property and casualty insurers in the United States struggle to maintain profitability. Executives will need to direct a coordinated response across pricing, underwriting, claims, and other functions. What P&C insurers can do as claims inflation pressures results in Europe, with an eye toward a likely tumultuous 2023. Claims executives can use a structured approach that includes transparent tracking, tactics, and strategic actions to tackle claims inflation in the short term and in the future. Capturing the climate opportunity in insurance, the world's transition to net zero emissions will cost trillions of dollars and present new kinds of risks. Here's the role insurers can play. Climate and insurance, how carriers are preparing for a net zero future. Decarbonization means a new risk landscape and new strategic skill sets for insurers. McKinsey subject matter experts from around the world discuss the shifts they're seeing and the road ahead. Listen to the podcast or read the transcript. Claims 2030, Embracing the Future. As technological change accelerates and customer preferences diverge, the future of claims organizations centers on 4 key trends. Watch the videos or read the transcript. The new standard for insurance claims. In this podcast, 3 claims experts discuss what insurers should consider as they update their technology, ways of working, and workforces to bring forth the future of claims. Listen to the podcast or read the transcript. Our most read 2022 article. 5 steps to improve innovation in the insurance industry. Insurance is not typically considered a bastion of innovation. Despite a long track record of creating new and exciting markets around emerging risks and consumer demands, industry executives are recognizing the power of innovation to accelerate the pace of company change, yet few insurance carriers have pursued innovation in a systemic way. Five steps offer a roadmap for building innovation into the way an organization works, competes, and grows. Opportunities for insurers in a rapidly shifting insurtech market. After years of growth, the U.S. insurtech market faces a sharp decline in valuations. How should established insurance carriers respond? Doug McElhaney. By Doug McElhaney. Leads transformational programs in AI and analytics for insurance companies. Jason Ralph. by Jason Ralph. Serves financial services institutions on strategy, distribution, and innovation, with deep expertise in life insurance and retirement. Digital and Analytics. December 14, 2022. For nearly a decade, insurtechs have experienced rapid growth and skyrocketing valuations. But in 2022, investors' optimism has been tempered by compounding pressure from inflation, rising interest rates, and geopolitical and macroeconomic uncertainty. Investors are increasingly looking for a sustainable business model advantage, a far cry from the growth at all costs focus in recent years. As a result, major publicly listed insurtechs have seen their valuations plummet compared with their all-time highs. The exhibit shows the compression of valuation for 10 publicly traded insurtechs that had previously enjoyed some of the largest funding rounds of the industry. This cooling has sent shock waves through the insurtech community and reminded players to balance their hunger for growth with scalable business performance. Exhibit: Opportunities for insurers in a rapidly shifting insurtech market. We strive to provide individuals with disabilities equal access to our website. If you would like information about this content, we will be happy to work with you. Please email us at McKinsey website accessibility@mckinsey.com. At the same time, rising interest rates and hard markets are benefiting many insurance carriers. This stands in contrast to the previous decade, in which insurers struggled to earn their cost of capital. 2 This struggle persisted due to a prolonged period of premium growth below GDP growth and was compounded by the impact of sustained low interest rates on life and retirement carriers. There was also an influx of alternative capital and elevated catastrophe losses on property and casualty carriers. The market dynamics today, with insurtech players facing headwinds and incumbent insurers benefiting from certain tailwinds, have effectively turned the tables across the insurance landscape, putting traditional insurance companies in a much more advantageous position relative to insurtechs. In light of this, executives should consider the acute, strategic, and tactical opportunities now available to them. Strategic implications for insurance carriers. The current environment has created new opportunities for carriers to raise their aspirations and move more quickly on their strategic priorities. To capture the opportunities, insurers will want to prioritize 3 strategic actions. Make bold moves. During the 2007-08 financial crisis, a dichotomy emerged between the winners and the losers. The subset of resilience not only widened the performance gap during and immediately after the crisis, but also carried that outperformance into the next decade. 3 Across sectors. Resilience differentiated themselves through similar actions, fast, decisive moves on productivity during the downturn to preserve growth capacity. Manda strategies characterized by proactive divestments and acquisitions to reshape the portfolio as needed, and the preservation of operational and financial options that allowed them not only to survive the crisis but also to accelerate through it. In the current economic landscape, bold strategic moves will be similarly essential. 4. Raise the aspiration for strategic bets and business building. The current downturn in the insurtech market might seem to suggest that big digital bets are not worthwhile. But according to McKinsey's latest Global Business Building Report, in insurance and financial services, every dollar of revenue from new businesses generates more than twice the enterprise value compared with every dollar of core business revenues. 5 Therefore, it is no surprise that 8 in 10 surveyed CEOs reported new business building as a top 5 priority despite recent heightened economic volatility. In insurance, companies with capital to deploy may be able to significantly accelerate the growth of strategic bets by building new businesses and boosting the trajectory of nascent businesses in their portfolio. Reevaluate build-buy decisions. Since their emergence, insurtechs have been continually transforming insurers' build-or-buy equations. Given the relative discount on existing solutions in the market and InsurTech's need for capital, now is the time to reevaluate those equations for both new and in-flight initiatives. As insurers raise the aspiration for strategic bets and business building, there likely will be substantially more opportunities to buy market access and capabilities now than at almost any time in the past decade. 2 tactics for traditional insurance carriers. Tactically, insurers can capitalize on the current valuation pressures on InsurTechs in 2 ways. Transform your talent structure. Compared with other industries, insurers have historically struggled to attract digital and analytical talent, even within financial services. As the initial disruption of InsurTech settles into and becomes part of the industry landscape, insurers could find themselves in closer proximity to the data scientists, machine learning engineers, and other next-generation talent initially attracted to the industry by InsurTechs, especially amid fluctuations in the InsurTech market. Insurers can strengthen their digital talent through recruiting or Manda. Be aggressive in procurement. InsurTechs have come to play a critical role in enabling the insurance value chain. In fact, according to McKinsey's InsurTech database, 63% of InsurTechs enable the value chain and cooperate with insurers. Given that the current InsurTech environment is characterized by a scarcity of capital and urgency to achieve profitability, insurers could have their strongest negotiating position in years with many of their current digital and technology vendors, as well as with vendors of platforms that they are considering as part of technology improvements and upgrades. Digital and analytics. October 12, 2022, fully in person for the first time since the COVID-19 pandemic began, more than 8,000 insurance carriers, distributors, investors, and InsurTechs gathered in Las Vegas for InsurTech Connect 2022. Despite the hit that certain InsurTech valuations have taken in the past few months, the atmosphere at the event was buzzing. As we talked to participants, we noted 5 important takeaways that insurers and investors should keep in mind for the coming years. Data and AI are expanding beyond personal lines of property and casualty insurance, but are slow to replace manual work. Last year, we noted the expansion of property intelligence solutions. This year, it was again seemingly the most popular category among providers on the expo floor. The COVID-19 pandemic improved customers' comfort with using digital channels, and now many insurance carriers have shifted significantly to become digitally enabled. The industry has started adopting more sophisticated data across commercial lines beyond real estate and property in areas such as commercial auto, workers' compensation, and general liability. Automation is more challenging, however. Many companies said they can complete a wide spectrum of actions digitally, from product customization to efficient claims processing, but many of those services have yet to be built or offered with enough accuracy to fully replace human capabilities. Claims estimating in auto insurance has been the most prominent use case for replacing manual processes with automation and AI to improve customers' experiences. Beyond auto claims, AI applications in areas such as universal workflow and liability detection are starting to emerge. As these new capabilities become more prolific, it'll be important for companies to distinguish their competitive advantage and develop clear use cases to stand out. Risk prevention and resilience is moving from human-enabled to data-enabled. In certain lines of business, such as cyber and general liability, managing general agents and other service providers focused on providing insights that assess risk levels and make risk prevention recommendations. In order to drive down loss ratios for insurance carriers and other capacity providers, what has historically been a very consultative process is now increasingly shifting to include data and tools to understand risk on a more granular level, focusing at times on very specific niches to deliver better results for the industry overall. This is particularly important given rising climate risk and physical risk, in addition to the risk of catastrophic events and their unforeseen effects. Digitally enabling specialty commercial insurers, particularly through wholesale distribution, is the next way to improve workflows in the industry. Some companies are working with wholesale brokers to create digital platforms that make connecting retail brokers, wholesale brokers, and insurance carriers easier. Others are building digital wholesale brokers to connect retail brokers directly with insurance carriers. The goal is to improve retail brokers' efficiency, broaden access to markets, and reduce the total cost of distribution, all of which are particularly important in the current environment. Digital wholesalers aim to create solutions that are flexible and often on no-code or low-code platforms, which can help them navigate fragmentation between commercial lines and address each line of business across all 50 states. The balance sheet is out, and profitability is in. This year, we noticed a significantly lessened presence from digitally native full-stack carriers that own the balance sheet. With valuations down and funding harder to come by, especially for the middle phases of growth, the main strategy from Insurtechs has evolved from building a full stack, for example, MGAs expanding to have a balance sheet, to developing a strategic plan for growth from the get-go to become profitable faster. This approach is enabling investments with the expectation of returns in 6 to 12 months. Cyber is seen as a looming catastrophic risk. At ITC 2022, many investors and business executives were excited about the increasing demand and flourishing supply of propositions across distribution, MGA, and threat intelligence, which contrasts the mood on cyber at this year's Monte Carlo conference in early September. Many ITC participants were offering new cyber protection products, and MGAs were vying for capacity and equity investment. The most important conversation about cyber risk at ITC 2022 was about the evolving role of cybersecurity in the industry. Many believe that cyber protection can work as a vaccine against risk. The more companies that have protection, the more cushioned entire industries are. Furthermore, customers might be excited about cyber monitoring services as part of their policy because it can help them earn premium credits for responsible cyber risk practices. Opportunity in the insurance industry remains strong, whether that means moving away from manual processes or using data in better ways. Companies that innovate around these pain points are well positioned to gain traction and scale. Come ITC 2023, we expect to see even more insurance carriers, distributors, investors, and Insurtechs get creative with the tools and services they have to offer. July 21, 2022. For decades, population growth and rising per capita income in Europe were accompanied by an increase in the number of vehicles purchased and kilometers driven. But mobility is at a turning point. The fight against climate change has changed all mobility-related industries, including the insurance market. And as customers become more aware of new technologies, such as autonomous driving and connectivity, both the automotive industry and motor insurers will need to change their product offerings and ways of working. These changes bring challenges to the insurance industry, but they also bring new opportunities. And as customers become more aware of new technologies, such as autonomous driving and connectivity, both the automotive industry and motor insurers will need to change their product offerings and ways of working. These changes bring challenges to the insurance industry, but they also bring new opportunities. The traffic turnaround. In 2021, European policymakers significantly enhanced their efforts to reduce transportation emissions. In accordance with the European Green Deal, companies have committed to cutting CO2 emissions from passenger cars by more than half by 2030, compared with 1990 levels. According to the European Commission, more than 150 European cities have already introduced access restrictions, such as reducing private vehicle use in designated areas. And electric vehicle adoption is expected to reach nearly 50% globally over the next decade. New technologies will also help ease the flow of traffic. The first Level 3 road congestion pilots, for example, can monitor traffic jams and switch the vehicle temporarily to autonomous driving. Level 4 highway pilots, which can monitor traffic and drive autonomously at higher speeds, are expected to be approved for private vehicles by 2025 at the latest. By then, 70% of all new vehicles are anticipated to be connected smart cars. Additionally, self-driving cabs are already on the roads of cities such as Phoenix, San Francisco, and Seoul. In China, they are projected to account for an estimated 2/3 of all passenger kilometers by 2040. Europe is also expected to introduce these types of vehicles to their streets in just a few years. Individual mobility still primarily means owning a car. But the consumer market has become more open to new mobility solutions. Electronically booked trips, known as e-hailing, tripled between 2016 and 2021, and the micromobility sector, small electric vehicles, public transport, and shared services, grew by 60% in 2021 alone. As these trends continue, more people will shift from owning a car to using alternative transportation options. How insurance will be affected. As the mobility sector evolves, so will the insurance market. For example, the frequency of claims is likely to decrease significantly in the coming years. At the same time, when accidents do happen, claims will be more significant because of the high cost of component replacements, such as sensors in vehicle bodies or batteries in electric vehicles. More dramatically, privately owned cars will become less popular as fleet businesses and micromobility grow, which will greatly reduce the largest business segment for most motor insurers. Insurance companies will need to develop new approaches to address the impending decline in car insurance premiums and compensate for this loss with new business models. Motor insurers will also have to get used to a different risk portfolio if liability is transferred from the driver to the manufacturer, an approach that some political leaders are discussing. To adjust, insurers will have to develop new competencies in product development and in actuarial, sales, and customer service departments. Across the board, the insurance industry must prepare itself for significant shifts in business priorities, the sooner the better. Where to start? Fortunately, such a change brings opportunities that nimble providers can capitalize on. According to expert estimates, vehicle connectivity alone has the potential to produce $30 billion to $50 billion for the global mobility insurance industry by 2030. That amount would be more than 10% of today's premiums. Below are 4 examples of new data-driven approaches that companies can use to seize the potential of mobility shifts. Behavior-based pricing. Premiums based on driving style or vehicle use give policyholders attractive opportunities to save. This approach can pay off in the long term if movement and vehicle data are used to make additional offers. New ecosystem offerings. With growth in direct sales of motor vehicles, car manufacturers are becoming increasingly important as partners. New ecosystem offerings. With growth in direct sales of motor vehicles, car manufacturers are becoming increasingly important as partners. But they should also be considered potential competitors as embedded offers, purchasing a vehicle and insurance from a single source, continue to trend. Insurers should strive to create partnerships within their ecosystem that benefit both sides. For example, they could integrate a simplified insurance offering into vehicle buying and selling using a seamless digital process. Multimodal insurance products. Providers can respond to the uptick in mobility diversity with appropriate insurance solutions. For example, they could offer one product class for everything from private cars to borrowed e-scooters to rental cars on vacation. This solution provides new customer groups access to the company and their insurance offerings that they might not have been exposed to before. On-demand services. After purchasing a vehicle, 39% of all buyers want to activate additional digital services. For owners of premium brand vehicles, 50% opt for these additional services. Insurers can take advantage of this ample demand by making extended services, such as international insurance, insurance for passengers, or active driver coaching, available at the push of a button. In the medium term, insurers can plan to jump at new business opportunities. Using the insights and data they have collected from mobility insurance solutions to grow into other areas of the mobility ecosystem. Fleet management, buying and selling used cars, the electric charging market, and car servicing sectors are just a few of the many options. More diversity also provides advantages over aggregators, which tend to benefit from standardization. As is often the case during change management, motor insurers will need courage and creativity to forge ahead. Companies that address challenges early on will emerge stronger by responding to the transportation transformation. What's more, they will play a key role in shaping the new era of mobility. Stefan Binder is a senior partner in McKinsey's Zurich office. Ulrike Dietgen is a partner in the Stuttgart office, where Stefan Paler is an associate partner. And Kirsten Heineck is a partner in the Frankfurt office. May 11, 2022. The rise of technology and changes in customer behaviors are causing industry boundaries to fade and ecosystems to rise. By 2030, ecosystems could account for 25% of the global economy. On-demand services. After purchasing a vehicle, 39% of all buyers want to activate additional digital services. For owners of premium brand vehicles, 50% opt for these additional services. Insurers can take advantage of this ample demand by making extended services, such as international insurance, insurance for passengers, or active driver coaching, available at the push of a button. In the medium term, insurers can plan to jump at new business opportunities. Using the insights and data they have collected from mobility insurance solutions to grow into other areas of the mobility ecosystem. Fleet management, buying and selling used cars, the electric charging market, and car servicing sectors are just a few of the many options. More diversity also provides advantages over aggregators, which tend to benefit from standardization. As is often the case during change management, motor insurers will need courage and creativity to forge ahead. Companies that address challenges early on will emerge stronger by responding to the transportation transformation. What's more, they will play a key role in shaping the new era of mobility. Stefan Binder is a senior partner in McKinsey's Zurich office. Ulrike Dietgen is a partner in the Stuttgart office, where Stefan Paler is an associate partner. And Kirsten Heineck is a partner in the Frankfurt office. May 11, 2022. The rise of technology and changes in customer behaviors are causing industry boundaries to fade and ecosystems to rise. By 2030, ecosystems could account for 25% of the global economy. Integrated offerings are increasing the relevance and growth of ecosystems across industries, and insurance is no exception. An analysis of insurer investments over the past 2 decades shows significant investments across several ecosystems. Insurers invested 32% of startup financing into health, 21% into wealth and protection, 20% into B2B services, and 10% into mobility. These integrated network economies provide enticing opportunities for insurers to strengthen their core business, explore new revenue streams beyond traditional insurance, and increase customer touchpoints. However, many insurance executives find it difficult to make their ecosystem vision a reality. To understand why, we surveyed 13 Latin American P&C and life insurers across 6 countries: Argentina, Brazil, Chile, Colombia, Mexico, and Peru. We ranked their ecosystem maturity across 7 critical ecosystem capabilities on a scale of 1 to 5 and assessed their readiness compared with global benchmarks from Asia and Europe. The results indicate that Latin American insurers have the most significant capability gaps in strategy, tech, data, and customer centricity, especially compared with international benchmarks. Ecosystem